What's going on, everyone? It's been a while, but we actually have a relevant filing that's hit the register today, and we are looking at SR NSCC 2022-013, and this is to amend the Clearing Agency Liquidity Risk Management Framework to include a new section describing the process by which FICC, or the Fixed Income Clearing Corporation, would designate uncommitted resources as qualifying liquid resources and make other changes. So let's go ahead and look into this. So this is the clearing agency's statement of the terms of substance of the proposed change. And it says here, the proposed rule change consists of amendments to the Clearing Agency Liquidity Risk Management Framework of NSCC and its affiliates, the Depository Trust Company DTC, and the Fixed Income Clearing Corporation, and together with NSCC DTC are the clearing agencies. So remember, the DTCC is the parent company, and then the subsidiaries of the DTCC are the DTC, the NSCC, and the FICC. Now, specifically, the proposed change would, number one, add a new section describing the process by which FICC would designate uncommitted liquidity resources as qualifying liquid resources, or QLR. We're going to refer to qualifying liquid resources as QLR from here on out. Number two would clarify that FICC may have access to liquidity resources that are not designated as QLR. And three, delete the standalone section on due diligence and testing of liquidity providers, and instead add due diligence and testing descriptions where each liquidity resource is described, or state where testing is not performed, as applicable. And number four, clarify the description of FICC's QLR. 5. Clarify the description of NSCC's and DTC's QLR. Add language to reflect NSCC and DTC's current due diligence and testing processes, and make technical changes as described below. So that's a lot to unpack. So let's go ahead and look at this. But before we do that, we have a super note here that's probably important because likely going to be referencing this CFR rule here quite a bit in this filing. So we're going to take a look at 17 CFR 240.17 paragraph AD-22. Let's go ahead and take a look. So if we look into this this rule here, we can see that the rule they're referencing is indeed qualifying liquid resources, or QLR, and this means for any covered clearing agency the following in each relevant currency. Number one, cash held either at the central bank of issue or at creditworthy commercial banks, that is considered QLR. Number two, assets that are readily available and convertible into cash through prearranged funding arrangements, such as A, committed arrangements without material adverse change provisions, including lines of credit, foreign exchange swaps, and, you guessed it, repurchase agreements, or other prearranged funding arrangements determined to be highly reliable even in extreme but plausible market conditions by the board of directors of the covered clearing agency following a review conducted for this purpose, not less than annually, and other assets that are readily available and eligible for pledging to or conducting other appropriate forms of transactions with a relevant central bank. So if you didn't think central banks were involved in all of the nonsense, they definitely are. If the covered clearing agency has access to routine credit at such central bank in a jurisdiction that permits said pledges or other transactions by the covered clearing agency. They're basically saying, in a nice way, rehypothecation. So that's basically what they were referring to when it comes to this CFR rule. So the purpose of this, the clearing agencies adopted the framework to set forth the manner in which they measure, monitor, and manage the liquidity risks that arise in or are borne by each of the clearing agencies, including 1. The manner in which clearing agencies deploy their respective liquidity tools to meet its settlement obligations on an ongoing and timely basis, and 2. Each applicable clearing agency's use of intraday liquidity. In this way, the framework describes the liquidity risk management of each of the clearing agencies and how the clearing agencies meet the applicable requirements of Rule 17 AD-22E7 under the Act, which, remember, we just looked at this, but we didn't look at this specific section, so now we're going to take a look at this specific section, which is, if you look at E7, each covered clearing agency shall establish, implement, maintain, and enforce written policies and procedures reasonably designed to, as applicable. Then we go to 7 here, specify clear and direct lines of responsibility. So again, at the beginning of this, they said that they're going to make technical changes and change some definitions. And the reason they're doing that is to make sure they're in compliance with E7 of this rule. Okay, so the actual changes. The proposed changes to the framework would, number 1, add a new section describing the process by which FICC would designate uncommitted liquidity as QLR. Number 2, clarify that FICC may have access to liquidity resources that are not designated as QLR. 3, delete the standalone section on due diligence and testing of liquidity providers, and instead add due diligence and testing descriptions where each liquidity resource is described, or state where testing is not performed as applicable. And then 4, clarify the description of FICC's QLR. 5, clarify the description of NSCC and DTC's QLR. Add language to reflect NSCC and DTC's current due diligence and testing processes for their committed line of credit, and make a correction to the description of DTC's collateral monitor. And 6, make technical changes. And then we're going to get into each one of these, but I'm not going to go into all 6. I'm only going to go into the relevant ones. The technical changes don't really need to get into. Number 5 here, don't really need to get into because they go into it in 4. Let's go ahead and take a look. So number 1, proposed amendments to add new section describing the process by which FICC is going to handle their liquidity, basically in times of market stress. So this proposed new section would explain that in order to designate an uncommitted liquidity resource as a QLR, FICC would first identify the properties of each financing arrangement, including the underlying collateral and the liquidity providers. Based on the nature of the liquidity resource, FICC would then determine the nature of the rigorous analysis that is appropriate for that resource and would conduct that analysis at least annually. Number 2, propose amendments to clarify that FICC may have access to liquidity resources that are not designated as QLR. The proposed changes to the framework would also make clear that FICC may have access to liquidity resources that are not designated as QLR. At this time, FICC maintains uncommitted master repurchase agreements, or MRAs, that can be utilized to finance via the repo market the securities in FICC's clearing funds and those purchased on behalf of a defaulting member to raise funds. While not designated as QLR, amounts available under the MRAs, or master purchase agreements, may be utilized as liquidity resources in the event of a member default. So they're basically saying right here that while not designated as qualifying liquid resources, amounts available under those master purchase agreements may be utilized as liquidity resources if a member defaults. The proposed rule change states that on a weekly basis, a study to estimate the depth of the repo market under prevailing market conditions, as well as the sample stress scenario to assess potential available liquidity in the event of default of the largest member, would be performed. So they're gearing up for some more experimentation, testing, and stress scenarios. Very good. Okay, then we're going to skip 3. We're going to go to 4 here. Proposed amendments to clarify the description of FICC's QLR. So they're going to be updating their description of QLR altogether. The proposed changes would make clear that each FICC division has its own clearing fund that includes deposits of cash. The proposed changes would also delete language regarding the ability of FICC to borrow from the clearing fund, as that is already covered in the rules of each division. The proposed rule change would clarify the description of FICC's QLR by adding language on same-day access to funds regarding deposits of clearing fund in creditworthy commercial banks. The proposed changes would also clarify that the rules-based committee capped contingency liquidity facility programs are determined for each FICC division per the division's respective rules. In addition, the framework would make clear that for purposes of making FICC clearing fund deposits, members are not considered liquidity providers. Proposed changes would add language to the descriptions of DTC's and NSCC's QLR to reflect DTC and NSCC's current practices of conducting surveillance of bank lenders to their committed credit facility and testing the committed credit facility at least annually to confirm that the lenders, agents, and respective clearing agency are operationally prepared to meet their obligations under the facility and are familiar with the borrowing process. So again, this is just a big big giant circle jerk of lending that's happening. Interfund lending collateral segregation. That's all it is. In essence, what they're doing here is they're adding a new section, obviously, describing the process by which FICC would designate uncommitted liquidity as QLR. They're going to clarify that FICC may have access to liquidity resources that are not designated as QLR that are involved in master repurchase agreements. And by updating the framework to reflect these changes, not only are they abiding by the rule that we first referenced in the beginning, but by updating them, the clearing agencies believe the proposed rule change would make the framework more effective in describing FICC's liquidity risk management procedures as they relate to FICC's liquidity resources. The proposed rule change would introduce clarity to the framework through the addition of a specific process regarding FICC's designation of uncommitted resources as QLR. It would better explain the section regarding FICC's resources that are not QLR. So they're changing some definitions. They're telling you what QLR is, what's not QLR, how they may get designated resources that are not QLR, talk about the master purchase agreements, and all that fun shit. Now, they're also going to delete the standalone section on due diligence and testing of the liquidity providers and instead add due diligence and testing descriptions where each liquidity resource is described. They're going to be clarifying the description of FICC's QLR. They've clarified the description of NSCC and DTC's QLR, added languages to reflect those changes, and their current due diligence and testing procedures. The improvement in this clarity, and the reason why they did this, is to improve the clarity which would assist the clearing agency in carrying out all of these functions. And finally, in addition, the proposed changes are designed to ensure that any uncommitted resource that is designated as QLR would be highly reliable in extreme but plausible market conditions. There you have it. New filing out of the NSCC. It is scheduled to be published on the Fed Register tomorrow. Hopefully you learned something. Have a good one.